Thank you guys for having me. I'm a pretty loud speaker, so if this is too loud or too quiet, let me know. I'm also a pacer. I don't like to stand in one place, so if I'm distracting, and I promise not to do circles, let me know too. So again, as Terry mentioned, I'm going to be talking about the new revenue recognition standard and how it affects nonprofits. How many of you have started having conversations with your clients about the new revenue recognition standard? Okay, someone please raise their hand. Anybody? Okay, I heard you're having them in your organization. That's good. Definitely something I can't encourage enough, that you start having these conversations sooner than later. There's just a lot of nuances to it, as you might imagine. I don't know how many of you have actually read the standard. I've tried and failed a few times because it's very daunting. But that said, I'm going to go through some slides that talk about some of the key aspects of the new revenue recognition standard and how it's applicable to nonprofits. I have up on the screen for you right now, broken down into 5 steps, the new RevRec standard. If you actually go read the standard, these 5 steps really aren't in there. This is what I call the Cliff Notes version of the standard, and breaks it down on a more simplistic level so you can actually engage in conversation with fellow members of management, whether it's a client or whatever role you may be in. So to walk through these steps here, step 1, identify the contracts with customer. Step 2, identify the performance obligations. I would say step 2 is where you'll spend a lot of time as you start to read the standard and think about how it can be applicable to your organization. And I've got lots of examples coming up, so I'm just trying to stay real high level right now. Step 3, determine the transaction price. Again, this one's usually pretty black and white, but depending upon what you conclude in step 2, it can certainly change the name of the game. Step 4, again, depending upon what you conclude as far as how many performance obligations, and then having to actually allocate that transaction price that you determined in step 3. And then finally, as noted in step 5, is when you actually recognize that revenue, depending upon what that performance obligation is and the time and all the other components of it. So I just have one slide here on conduit debt before we really dive into some more of the specifics on RevRec. I don't know how many of you are familiar with conduit debt or actually are involved with it. So really a conduit debt, if you're the obligor, is basically where you issue like a revenue bond and you intend on passing those revenues or that funding on to someone else for a capital financing activity. So it has to be passed on to someone outside of that organization. And just as I've noted here, conduit debt is affected by 606, and it's for annual periods beginning after 12/15/17. And as you can see here, the second bullet point there on the left, any nonprofit that has indeed issued or is a conduit bond obligor that are traded, listed, or quoted on the exchange or over-the-counter transaction. Is anyone affected by conduit debt in this room? I see one hand. Okay, we can talk more later if you've got questions. That seems to be a common theme whenever I'm discussing 606, is not a ton of organizations are impacted from the conduit debt, so I didn't want to spend too much time on something that's not applicable. Okay, so breaking down a little bit more of the standard. Again, this is staying pretty high level at this point. Starting with the blue box, does the contract fall completely within the scope of other accounting guidance? If yes, then don't you follow 606. If fully under, then yes, we certainly apply 606. And again, going back to that slide with this 5 steps, as you walk through those steps and start to answer those questions and read your grant agreements or contributions that you've received, that will help steer you through this roadmap, if you will. Again, if you are using other accounting guidance to separate the contract and initially measure the non-606 element, exclude the amount of the contract that is under other accounting guidance. So I think that's something important to keep in mind, that you might have multiple components to a contract, and a portion of it may fall under 606, and a portion of it may fall under another accounting standard. So this can get real complicated real fast. I'm not sure the size of your organizations or your clients. A lot of mine in the Kalamazoo office, I guess I'll say luckily, are on the smaller side by definition, and they're not finding that they're having a too terrible time trying to, they walk through the 5 steps, and it's either all of it's under 606 or all of it's under a different standard. So really diving in now the part of 606 that's applicable to nonprofits, contributions versus exchange transactions. Say that 5 times fast. Again, this is where you want to make sure you as an organization, or if it's a client, you are actually reviewing these contributions, and if there's an agreement or contract or anything that goes along with it, to make sure you're reading the wording, because that's probably what's most critical. The next 2 slides, I've just got some basic definitions. So to start with, a contribution is an unconditional, that's probably the key word right here, is unconditional transfer of cash or another asset to an entity, or a settlement or cancellation of its liabilities in a voluntary, non-reciprocal, also important, transfer by another entity. Because a contribution is both voluntary and non-reciprocal, it is not included within the scope of 606. So really that last bullet point is what's driving this home. It's voluntary and non-reciprocal. There's no stipulations or obligations that come along with it. Moving on from there, an exchange transaction. So it's almost the inverse of a contribution, a reciprocal transfer. Sorry, camera guy, I'm not helping you very much. Between entities that result in one entity either obtaining a service or an asset from that other organization by surrendering or doing something. Therefore, there's an obligation or a performance measurement that goes along with that. A few things that kind of pop into my mind, like a museum membership is one that I always use. I think this is probably a good one. Frequently, you might see with a museum membership, you pay a fee, you get an annual membership, but maybe you also get the museum's monthly or quarterly newsletter. Maybe you also get free or discounted parking at the museum. Those are considered separate performance obligations within that membership that you purchase. There's different things or separate things that you're getting with that membership. So the actual payment of the membership fee itself is considered an exchange transaction. You are paying a fee to become a member, and in turn, you're obtaining the ability to actually have access to that museum. And again, just reiterating here that last bullet point, because an exchange transaction is reciprocal, in which 2 parties receive value, right? So if I'm the museum, I'm getting the money. You as the member obtain, again, parking, newsletter, and the actual pass to the museum. Okay, distinguishing contributions and exchange transactions. I think I just gave you a good one, but when it's an exchange transaction, there's a transfer of assets or a service is performed. So it may appear to be a contribution if services or assets given in exchange are perceived to sacrifice of little value and the exchanges are compatible with the recipient's mission. So again, I think as an organization or if it's a client, really making sure we understand the nature of the transaction and actually asking these questions perhaps of ourselves. Again, what is the value? Is something being exchanged? And if so, what it is? And does it go along with our mission as an organization? The last bullet point here, again, I think a lot of similarities here for nonprofits. Maybe we receive from a foundation, for example, resources to use for our programs, and it might be labeled a grant. And I think, just to throw it out here, the word grant really doesn't have an accounting definition. It frequently gets used interchangeably between a contribution and an exchange transaction. So again, I keep saying, make sure you're reading your grant agreements. Make sure you're reading the grant agreements to make sure you understand what is required, either if you're the recipient or if you're the donor. As it mentions here, assets are considered contributions if the resource providers receive no value in exchange for the assets transferred, or if the projects in this area value received by the resource providers. Going back to my museum example, again, that's probably the biggest change with 606 versus old guidance, is that historically you'd see museums just recognize that entire membership fee, at the beginning of the year for that annual membership, we'll say. Now, again, with 606, that museum is forced to carve out and identify those separate performance obligations that come along with that membership. So a grant made by a resource provider to a nonprofit organization would likely be a contribution, again, if it's planned and carried out by the nonprofit, and the nonprofit has the right to the benefits of carrying out the activity. So again, making sure we're understanding who's getting what or who's giving what in this transaction. And as mentioned here, and I think I said it before, a single transaction can be both partially an exchange and a contribution. A lot of times, again, going back to my museum membership example, you'll see where people will make a donation perhaps, where the membership fee is, they'll say $60 and somebody might give 80, right? Because they want to give an additional contribution. So making sure that our clients or we as an organization are tracking those contributions in that transaction. Again, if we're selling membership fees or if it's dues or whatever the case may be, making sure that we're tracking that. Okay, so I've got 5 considerations here to distinguish contributions from exchange transactions. The resource provider is not synonymous with the general public, so therefore there could be indirect benefit received by the public as a result of the assets transferred. It's not equivalent to the value received by the resource provider. So again, making sure we're walking through and understanding who's receiving what and if there's actually a value to it. And also, does it align with the resource provider's mission or the positive sentiment, acting as a donor shall not constitute commensurate value received by the resource provider? Again, step 3 here, or another third consideration for trying to differentiate between an exchange transaction and a contribution. If the expressed intent asserted by both the recipient, us as the organization, or the provider is to exchange resources for goods or services that are of value, then the transaction shall be indicative of an exchange transaction. So again, if it's not voluntary, if there's that exchange, you can almost always guarantee that it will be deemed an exchange transaction. In contrast, if we receive a grant from a foundation and we have full discretion in determining the amount of the assets, and we are free to use it how we want, then that would be a contribution. But again, if the recipient and the resource provider agree on this together and there's stipulations and obligations as a result of that grant to our nonprofit, then that's also an exchange transaction. Frequently, you'll also see penalties, perhaps, that go along with a grant. Perhaps we're required to do things, or certain milestones, whether it's not sales, but volume of revenue, maybe it's quantity of memberships. There's stipulations that a grantor might put on a grant that we receive as an organization. So that also will be indicative of an exchange transaction. Some difficulties. I don't know how frequently this happens, but it certainly can. It says if an entity receives assets accompanied by certain stipulations but with no specified return policy. So again, maybe a foundation gives us a grant and says you have to increase your membership percentage by 25%, and if you don't, then you have to give the grant back. But they don't really say when. That can create a little bit of a gray area for you to work through and determine or classify it as a contribution or exchange transaction. I've actually had a couple foundations that are actually, the finance directors are former BDO alums, so that helps, but they've been really proactive with this Revenue 606 to where they do have some of these grant agreements where not everything was perhaps clearly as spelled out as it could be or should be. So they've actually gone back to their funding sources or their grantors and said, can we clarify this? Can you add to it to make sure that, one, gosh forbid, we don't meet your stipulations and your restrictions. We know exactly what the ramifications are and what that timeline is, but also, two, to help on their side from a bookkeeping standpoint to help them clarify if it is indeed a contribution or an exchange transaction. And as I mentioned here, differences in these conclusions, depending upon what your agreements say, can affect the timing of when that revenue is recognized. I don't know how well this next slide's going to show up here, but hopefully it does. So again, determining what a barrier is. So would consider indicators, but not be limited to. I've got a few slides here on this. So again, really trying to walk through the 5 different steps of 606, also as well as trying to determine is something a contribution or an exchange transaction. So here are 3 barriers that I have noted. The inclusion of a measurable performance related barrier or other measurable barriers, whether a stipulation is related to the purpose of the agreement, and the extent to a stipulation limits the discretion by the recipient. I'm going to walk through each of these barriers with you. Okay, measurable performance. I just threw out some of these 4 bullet points are just some pretty generic examples. I touched on this a little bit with the museum. So maybe we receive a grant and there's a specified level of service. Again, maybe it's just revenue growth at the museum, maybe it's membership growth. Maybe we're going to be required to match that grant as an organization, or there could be just another outside event. But again, making sure we have a very clear understanding as to what these barriers may be if they do indeed exist. Barrier 2, stipulations that are related to purpose of the agreement. So that's probably the key there, is if it's related to. Making sure, again, when we're reading these agreements, and I keep using the word grant, I'm kind of using that interchangeably in this case. Whatever funding source that may be, I'm going to use the word grant agreement in its place. So any stipulations that are indeed related to the purpose of the agreement, barriers can be helpful in the context of considering the agreement with other indicators. So if a stipulation is unrelated, and I think this is a good example here, maybe we have to produce an annual report to our grantor. It's not typically related to the underlying purpose of that agreement. Meaning there's nothing that's actually going to change. Certainly your grantor, I'm sure there's some ramifications, right? If the grantor says you need to provide us with quarterly or annual reports, and we don't, they're probably not going to be as apt to provide us with those funding sources in the future, but it's not as specific as far as related to the purpose of that grant. So again, maybe they're giving us a grant to help increase our museum memberships, and we don't, that's a whole nother issue. But just because we don't produce an annual report, it's not as directly tied to the purpose of that grant. Barrier 3, stipulation limits discretion by the recipient. So again, are we limited as to what, when, how, or why we can spend those funds? As it mentions here, limited discretion may be indicative of a donor-imposed condition. A resource provider could include a requirement the assets must be spent to achieve a certain level of service or number of units of output before we're actually entitled to those assets. And a resource provider may include a right of return, right? Maybe if we don't meet their performance obligations or their stipulations or requirements, then they could say, give us our money back. I seem to have flown through those first few slides. Does anyone have any questions? Because I've got quite a few examples that I'd like to kind of make this a little bit more real world. I know I keep beating up on my museum example, but does anyone have questions at this point? Okay. So I've got some case studies or samples, however you want to. So I thought maybe what we could do is take 5 to 10 minutes amongst yourselves and kind of talk through it, and then I will talk through it with you as far as what the proper conclusion is, just to make this a little bit more applicable. So I'll talk through this, and then, like I said, I'd like some feedback, hopefully from someone that's got a thought on the answer here. So we, as an organization, applied to receive a grant from a private foundation for funding for $400,000 for career training for disabled veterans. The grant requires us to provide training to at least 8,000 veterans during the next fiscal year, with specific minimum targets that must be met each quarter. The provider specifies a right of release from the obligation in the agreement that it will only give us $100,000 each quarter if we demonstrate that those services have indeed been provided to at least 2,000 vets during each quarter. So does this sound like a conditional or unconditional contribution? Correct. So it says that we determined that it should be for this grant a conditional obligation. The agreement contains right of release, right? We know very clearly what it is, that we have to make sure we service 2,000 vets per quarter, and they will release the funds accordingly. And the last sentence here, it says we should record the revenue as it overcomes the barrier of providing services to 2,000 disabled veterans. So I guess to put this in contrast, if they didn't give us this, right, we could if they didn't put the stipulations on a quarterly basis, they could, and if they gave us the funding up front, then we could just recognize it all at once, because it did state in the example for our next fiscal year, so it is just an annual term. Case study number 2. I'll give you guys just a minute to read it, and then we'll walk through it. All right, case study number 2. So we as a nonprofit run an animal shelter, and we received a 2-year unsolicited grant from a private foundation. in the amount of $500,000 to be used and received upfront to expand our operations. So similar to my previous example here, but does this sound like a conditional or unconditional? What makes it conditional? Yep, so I heard a lot of different things. The performance obligation, it does state that we must expand our facility by 5,000 square feet. And then also it does mention in that last sentence that the right of return of any unused assets. All right, so number 3. We're a public charity that work with gluten-related allergies as part of our mission. We applied and received a $100,000 grant from a foundation to perform research on gluten-related allergies over the next year. The grant agreement includes a right of return, and it also indicates that the general budget must be submitted previously with the grant proposal, must be followed or approved, and be obtained from the foundation for any significant deviations in spending. The grant also includes a requirement that at the end of the grant period, a report must be filed with the foundation that explains how the assets were spent. Conditional or unconditional? I feel like I heard both. I think I heard conditional and unconditional. Okay, so I heard unconditional up here, and the answer is unconditional. So for the purpose of research on these allergies results in donor-restricted revenue, right? We're receiving this revenue for a specific purpose, and it's to do research around gluten-related allergies. We determined that the general budget included in the grant is not a barrier to entitlement, so it's not changing anything, and the foundation has to approve that budget when we submitted it. And because there's no deviations from that general budget, which allows for broad discretion, and there are no additional requirements in the agreement, such as incurring qualifying expenses that would indicate a barrier. We also determined that the reporting requirement alone is not a barrier because it is simply just an administrative requirement. Does that make sense to everyone? Okay. So I'm going to back up, actually, and speak a little bit more to, because I'm at the end of my slides. I feel like when I've done this, I've had more questions, so please ask. To these 5 steps, and kind of just speak to some of my examples that I've seen with my nonprofits and things that you guys need to make sure you're focusing on. Again, I think identifying this, use the word contract, again, that's just 606 language. But again, as an organization, we need to make sure we have a clear understanding of our revenue streams. Is it contributions, donations, grants, you name it. I think step 1 is the easiest, where probably the very least amount of time would need to be spent when walking through 606. As I mentioned before, identifying the performance obligations. I can't stress this enough because, again, my museum example, not to beat that one up some more, but is probably the biggest difference, again, with 606 and the old accounting standards for revenue recognition. Again, a lot of times nonprofits did not bifurcate and acknowledge the different performance obligations associated with their revenue streams. And so again, it's really taking a hard look as to what those performance obligations are. Again, with that museum membership, if it's, let's say, $60, but you also get the newsletter and the parking, and you now have to take that $60 and allocate it to each of those 3 items and recognize your revenue accordingly. Certainly can be a very tedious process. I'd say one of the biggest things with my clients I have learned is to kind of talk through this with them. Definitely a lot of back and forth, but come to a conclusion and just be consistent on it. What we've even learned at BDO through our public clients that have adopted this, not that I like to talk about this, but the SEC has actually said, make up your mind, determine how you're going to allocate or how you're going to record revenue, make sure it's documented and supported, and generally, unless it's completely wrong, no one's really going to challenge you. So there's definitely some gray area, I would say. But again, if you've worked through it as an organization or with your clients and documented accordingly, again, if you remember too, part of the RevRec standard is, that little maybe 1 or 2 sentence revenue recognition sentence or contribution paragraph in our statements and the accounting policies is probably going to double or triple in size. And what that's getting at is more clear, transparent disclosure as far as how we as an organization are actually recognizing revenue. So again, if you as an organization have walked through this process, these 5 steps, come to a conclusion that, and again, you don't have to do every last grant that you receive, because I think certainly in the nonprofit realm, grant agreements can wildly vary from one to the next. The standard is certainly not wanting you, is not wanting you to necessarily look at every grant agreement, read it back to front, and expect you to have perhaps a different policy for recognizing revenue, but instead taking a more holistic, general approach, saying, here's a bucket of grant agreements that we receive, and therefore these types of agreements we're going to recognize revenue per X or whatever it is that you guys conclude as an organization.
Speak a little bit to how this may affect clients that we have some nonprofits in the room that don't rely so much on contributions or grants, but maybe have a product that they're selling. Can you speak to how maybe revenue recognition will apply to those kinds of clients?
Sure. So for those that didn't hear the question, she asked or noted that several of the nonprofits in the room, it's not so much relying on contributions as your revenue stream, but selling of a good or service. Same thing, I would say for you guys, if nothing else, you're probably going to fall more into that exchange transaction, right, as opposed to a contribution. Because again, something is being traded for and there's conditions, right? You are going to buy this from us or we're going to sell it. Therefore, there's a value in the exchange, right? We're mutually benefiting from it. So again, what I have also learned is, from an accounting standpoint, not a lot has changed with my nonprofits. They're finding as they've walked through these 5 steps that they're not actually having to change anything from an accounting and a revenue recognition standpoint. It's more documenting that they've walked through this process and justifying and explaining their rationale. So I guess in general, they're probably not going to change anything if they're selling or delivering a good or service to someone. It's just, again, making sure you've properly categorized it between a contribution or an exchange transaction. Does that answer your question? Okay. So step 3 is, I think I started to say, like with my museum example, you have to determine the transaction price. That, again, is usually pretty black and white for an organization. I'll use my $60, and then actually allocating that transaction price. Now, obviously, that's pretty generic, because I said we sell a membership for $60, and along with that, you get a newsletter and a parking permit. It'd be pretty easy to come up with a value, right, if someone wanted to buy each of those individually. So to allocate that $60 is pretty easy. Again, where things can get a little sticky, right, like how many people actually subscribe to your newsletter? Do people actually buy it, or is it always given as a gift or in conjunction with the membership? And then again, depending upon how you allocate that price, determines how and when you actually recognize that revenue. Now, that's not to say that if historically we had recognized that entire $60, let's say, as a membership in the past all at once, that once we say, okay, there's really 2 other performance obligations, the newsletter and the parking, that we actually change our recognition of revenue? Quite possibly not. Again, it's just the 606 is wanting to make sure that we're really scrutinizing and have a very clear understanding as to how and where our revenue is being generated. Does anyone have questions or any other examples that you guys are thinking of from a real life? I feel like that's probably the hardest thing with 606, especially with nonprofits, is it depends. And I really hate saying it, but I do feel like I say it a lot, because there's just so many nuances and differences from one organization to the next. To make a blanket statement is not necessarily the most accurate. So that's why I'm just trying to stay as generic as possible. And I would love if anybody has any specifics they can share or questions that's maybe eating you up inside, keeps you up at night. Yeah.
We have grants we owe up, and we become more on some of them rather than subcontractor. They view us as a service provider, so it's cost reimbursement. So if we have some people that are doing a different service with the youth and summer management, do we have to break those out as a different service, or can that just be?
So you are acting as a service organization, is that correct?
Yes.
Okay, so she said she receives grants, correct? And you are a service organization, and you're saying part of the funds may be spent on X?
Yeah, we have staff, and some of them are management, some of them are case managers, some are, JAG.
Yep.
Oh, right now, it's just, we're submitting a cost reimbursement as that service provider, and that's all we have is in the form of a contractor, not a sub-grantee or a vendor.
Mm-hmm.
So we need to be splitting out the three types of debt service.
So she receives the funds as a service organization, and they get spent in different areas of that organization, whether it's management or otherwise. So she's asking, does she need to split those out and recognize revenue separately? I would say no, as a whole, again. The only thing I can think of is unless you're a grantor, and again, I know this probably sounds very redundant, but unless your grantor has put more clear stipulations, as far as, I'm sure there's restrictions on what you can spend on which category perhaps, and even if there's not, unless they're going to be more specific, no, you can just treat it as one lump sum grant, and that's just from an internal standpoint as far as tracking. We spent X dollars in X category, and then you submit for reimbursement back to that grantor. So again, a lot of it does fall back to the grantor. Like I said, one of my foundations, in a couple instances, they've gone back to the funding sources and had them put additional language right in their grant agreements, usually with no problem, because again, it's not like anything is changing, but they wanted just as kind of a CYA, if you will, from their RevRec documentation standpoint, that this is the language right in the grant agreement, therefore, this is our conclusion as far as how to recognize revenue. So again, I don't know what your funding sources or your grantors are like in your relationships. Hopefully they're good ones. And if necessary, you can go back to them. Or sometimes I even have clients where they've just had a simple phone conversation to clarify that they're not missing any stipulations or obligations that this grantor is expecting that would result in them concluding differently for their revenue recognition. And sometimes they'll just document it in an email and put it in their files. So it certainly doesn't have to be as formal as going back and asking them to rewrite the grant agreement. What else? I can keep talking for hours, but I feel like I said, I just want to make this as useful and as applicable to all of you as possible. Because until you actually start to walk through it with your clients or you as an organization, you just never know. Yeah. Sure.
So let's say that you get reimbursement from, let's say, Blue Cross Blue Shield for services providing to your patients. You have a master rate schedule, so $300 per hour for that service. Blue Cross Blue Shield, you have a contract with, so you're going to $600. Walk through how you set that up. Accounting change from what you normally do now, you have a gross charge, contractual adjustment now, and that revenue.
Yep.
Going forward with RevRec, that number really is changed. The net revenue number isn't changing, it's just how it's collected.
Correct. Yep. So his question, for those that didn't hear in the healthcare organization, let's say you receive funds for providing a service of $300. Blue Cross Blue Shield, you have a contractual agreement with them. And they say, we're going to give you $100, right? They're never going to pay us all $300. That'd be great if they did, but that's not how life works. So he's asking, from a revenue recognition, what's changing? I'll caveat, I'm not a healthcare expert, although I did just inspect a healthcare nonprofit organization in Boston. So to your point, I agree. The amount of revenue is not changing. Again, I would go back to those Blue Cross agreements and see what they say as far as their terms of reimbursement from a timeline standpoint, as well as that remaining $200, from a collectability standpoint. I know, like I said, this organization I just inspected, it was to low-income, impoverished areas, so they didn't really have to worry about ever recognizing that $200 because they were never going to collect it. So it was just more of a contribution of their services at that point. So I guess collectability of that remaining portion may drive how and when you recognize that revenue. Again, if I was to take a wild guess, nothing is probably going to change. I know that's a pretty generic answer, but that's basically what this client found as well. They had actually kind of done some preliminary 606 work with this client, and that's basically what they concluded, that the timing of our recognition of revenue is not changing. It's just like, again, it's getting you as an organization to walk through the steps and make sure we're not missing a piece of it. Yeah.
So it's flip it from not having a contract to a private pay, still the $300.
Okay.
But obviously private pay people, there's a charge for it, they're not going to pay close to anything for it. So when they look at the recognized revenue for private pay individuals, it's going to have to be on a historic collection.
Yep, you hit the nail on the head. So he kind of did the inverse of his first question. His second one was from a private pay standpoint. So Blue Cross is not involved. Does anything change from a revenue recognition standpoint when we're just dealing with the customer directly ourselves? And what he said is absolutely correct, that it's going to be based on historical pay rates is what you can leverage to determine if anything should be changing. Again, I'm sure as a healthcare organization, they have great records, and that's certainly something they track from a historical trend standpoint. I'd be flabbergasted if they don't. So again, nothing will probably change as far as when they recognize revenue, if they indeed have a good grasp on their collections with these private pay customers.
Because in that example, you're really not going to have that debt, or technically, you're not supposed to have that debt anymore.
Right.
Because you're supposed to be estimating exactly what you're going to get reimbursed for, therefore your net revenue should be exact versus what you're showing in that expense.
Correct, should be, but
It's not.
exactly, yep. So what he said is, part of what the new RevRec is trying to drive home is that you're recording net. You're going to record what you're actually receiving in revenue, and like he said, especially with a nonprofit, that's probably never going to happen, right? It's not like, especially with private pay, we're never going to collect 100%, and the best we can do is leverage our historical pay rates with our customers and use that as our best guesstimate. So again, I think where we need to make sure we as organizations are documenting what those trends are, why we've concluded, recording what net percentage of our revenue based on these historical trends, making sure it's documented is probably the best thing I can say, because again, this standard coupled with the lovely new nonprofit standard from a financial statement standpoint, there's definitely a lot of changes coming down the pike. So the more conversations you can have with people, the better, to make sure that everyone has a good understanding. I think also too, what I've found with my nonprofits is perhaps program directors or the individuals that oversee grants don't talk to accounting enough to make sure that they're on the same page, and that individuals in accounting somehow communicate this to our program managers and grant directors, because needless to say, this is probably well beyond their realm of understanding, which is fine. But again, making sure that those departments are actually working together to make sure that we're not missing anything, that the individual overseeing the grant is telling accounting if there are obligations or stipulations or restrictions. So therefore, we as accounting, as we walk through these 5 steps, we're not missing anything when we're trying to determine what the performance obligations are and how many we have and what the time restriction is that go along with them.
Applying for the grant.
Yes, as she said too, the people applying for the grant as well. So definitely, like I said, I think hopefully it brings your organization together, and hopefully we're not, working completely in silos. But again, I think that's probably what I found at a lot of my nonprofits as well that I audit, is it's forcing them to come together even more so as an organization. A lot of my nonprofits that I audit, their accounting team is a whopping like 3 or 4 people. So we're not talking about large organizations. And then they'll have one person that oversees grants. So again, forcing those individuals to come together and make sure we have copies of all of these agreements. I've certainly read through more grant agreements for my clients in the last year than I care to admit. But again, helping them walk through this 5-step process and to make sure that they've got a good grasp on things. So again, usually not a lot changes as a result, but making sure it's documented. Does everyone feel comfortable with the, sorry, go ahead.
We're not for profit with a retail outlet that issues reward dollars.
Oh boy. So she said she's a nonprofit organization with a retail outlet that offers reward dollars and points. So again, your historical trends as far as, I'm going to use the term breakage, so I actually audit casinos, but it's very applicable here. Individuals earn X amount of points or reward dollars over time. What is the duration in which they have to use them, or do they never expire? Hopefully we're tracking to an extent what percentage of those dollars just in its total actually get redeemed, right? Because I know I'm probably guilty. I got like a reward card everywhere I go, and I forget I have them and never redeem them. So hopefully that your organization, you're welcome. Hopefully your organization has a good grasp or tracks how many points have been earned, what percentage of individuals actually redeem those points. And then based on that percentage, maybe what percent get redeemed in the first year, the first 2 years, we call it the breakage. At what point does it just completely fall off and then those points will never get redeemed? Is definitely something you're gonna wanna walk through to make sure you can substantiate and support the revenue that goes along with those dollars or points or rewards. So, it's a very good question. What else? I feel like this half the room's very quiet. Yeah.
Forgive me, I'm an executive director of a very small nonprofit, so it's a little bit out of my head. But looking at contributions versus exchanges. Using your museum example, we provide educational programming here in the community, and we have a membership club for our alums, like exclusive invitations or our occasional email that comes out. There's no guarantee that people who pay their $50 annual or $500 lifetime dues are going to come to any of our events, which they still may pay a nominal fee. We're just providing them an email invitation to them.
Okay.
So that's not even all of our events. And would that be a contribution or would that be an exchange?
Unless there's something more specific that you could put a value to. So again, like in my museum example, someone buys a membership, but they also get our newsletter and parking, right? But someone could purchase those items individually, right? So you can more easily assign a value to them. So unless your membership has something else that comes along with it that you can assign a value to, I would say no, you just have that one performance obligation, which is their membership to be an alum of your organization, and you can just recognize the revenue, just as you have been doing, I'm sure. It's like I said, it's really only when you can, I'll back up to the slide. Sorry. So identified the contract, right? Someone purchases a membership to our alum organization. What are the performance obligations? Well, technically it's just you buy it, you pay, and you now have it for the next year, correct? So there's nothing separate within that membership that they're getting, other than maybe an email blast that says, hey, we're having this special event. But they're not really obtaining anything else of value. You're not providing any other additional services to them, so there's no separate performance obligations. What else? Okay, so is everyone clear? I think I started to ask. On the exchange versus contribution, again, I know I keep belaboring this, but this is, again, probably the biggest change with 606 coming down the pike, and us understanding, are these funds or monies coming in voluntary and non-reciprocal? Because those do not fall under the definition of 606. I have no idea what time it is. I apologize. I put my watch on this morning and it was dead, so. What's that?
11.
So we've got not quite 10 minutes left. Is there anything else you want to ask me just from a nonprofit standpoint? Otherwise, I do have a couple other things I can speak to. I just, like I said, want to make this as applicable as possible to all of you. Get your time and money's worth out of this. Again, going back to the conditional versus unconditional, I think where that's pretty clear. You guys did well with the examples. I think, again, the time where you want to spend is determining if it's an exchange transaction or contribution. Because that is probably a couple things where I found with my private foundations where something they had previously treated as a contribution is now being treated as an exchange transaction. So, like I said, I know I keep beating it up, but spend some time there, make sure you have a clear understanding. Well, if no one has any other questions, you might be done 10 minutes early for lunch. I know, I thought that would devastate all of you. This last slide I'll just leave up. So you've got my contact information. Please feel free to email me or call me with questions. Always happy to help. As Terry mentioned, we work very closely with Kruggel Lawton. I'm down in this neck of the woods, or St. Joe back in my hometown quite frequently. So happy to help any way I can, or certainly reach out to your contacts at Kruggel. That's certainly okay as well. So thank you for your time today. I appreciate it.